Hey guys, Boris House from BK Force. Welcome to our Forex weekly technicals for 11/3 to 11/7/2014. Where are the trades? Well, unbelievably interesting week this week. Obviously, lots of volatility. We'll start with the euro first, although that wasn't the primary pair to trade, but it did have an interesting fall today. We tested at 25 again, the 125 level, and next week obviously sets up a massive, massive possibility here in the euro, because the thought here is that if the ECB does finally commit to some sort of a official QE program, then you have the final straw that breaks the camel's back in terms of policy divergence away from what turned out to be a much more than hawkishly expected Fed, what is now a very, very dovish BOJ, and what now becomes a very highly pressured ECB to sort of follow in those footsteps in order to stimulate the economy. The story out of the Eurozone continues to be very lackluster. German retail sales are horrid. There is still positive production in both manufacturing and services, but all of it is literally right above the zero line, and inflation remains a very, very serious concern. Rather, deflation, it remains a very serious concern. So some need for stimulus is really critical, and that's why the pressure on the euro really becomes quite severe. Today was a relatively decent test at its 25, but they bought it all back because we don't have the kind of informational confirmation that we need in order to break the break this level. But a breakdown here really opens up a run all the way out to 122. So we've had this sort of initial reaction, consolidation, retrace, and almost a full circle come back to this 25 level, which is where we hang. And it looks to me like we're probably going to be hanging this 25 to 26 until Thursday, ECB, at which point we could really resolve this one way or the other. So to the top side, though, if we do have a hawkish surprise to the upside, the top side here still caps us at 27 and of course 28. And it's unlikely, I think, it's going to resolve itself above that level unless we have some sort of organic growth, unless we have some sort of complete radical change in perception. For now, the equilibrium perception in terms of where we stand, which is a hawkish Fed, a neutral ECB, is this 25 to 29 corridor. That's effectively where we're going to be trading. So we're at the bottom end of this range. If you think there's a bounce, it creates a very interesting opportunity. But a break here does open up a whole new level of downdraft all the way out to 122. Now the yen, of course, was the huge story of the day today. Look at this massive move today. I think it's one of the largest moves we've had in 2 or 3 years. Practically, I think it's literally, yeah, a 300-point move, which is really astounding for the yen. One of the things that happens, by the way, when yen has these kind of really massive moves is it's very natural to have consolidation. And the first level of consolidation, of course, is 112. The next one is 111. But it's really not at all impossible to imagine that this whole big burst up could retrace itself all the way down to 110, especially, and this is absolutely critical, especially if all of next week we have a disappointing drumbeat of U.S. data. Now that's unlikely to happen, but if we have misses on the ISM manufacturing, if we have misses on services, and more importantly, and this is really absolutely critical, if we have a miss on the NFPs and lack of any indication that wages are growing, all of those things could create a massively negative move, retrace us back down to 110. To the top side now, it's really open races. We don't have any resist all the way to 115. This is fresh 6-year highs. It's certainly a massive break. And looking at this trade, you kind of really, you really want to start. You want to keep buying the highs here because fresh highs, I think, lead to fresh highs in dollar yen. But having said this, though, I think you'd want to see some fresh highs before you want to start buying here because of the fact that the pair, I think, is really tends to overextend itself and correct itself historically. But it's just a very interesting trade, and of course, it opens up all the yen cross and everything else around it. As far as pound goes, pound is really a non-story. It continues to be a non-story. We're basically sort of holding this 159, 161 pattern. It's really going to trade on anti-dollar flows for the time being. There is really nothing new on the UK side, because what's interesting about the UK story is that while the UK economy is puttering along, the UK monetary policy, and this is really the single most important thing when you're trading currencies, is to understand where the policy shift is going. The policy shift is resolutely neutral. We don't have any data next week that's going to make us change that mind. We do have, of course, a couple of UK indicators. We'll see if the economy had picked up a little bit of steam. But so far, policy has remained resolutely neutral, meaning that they're not about to go into a hike mode. And the notion that pound was going to be first to hike has really completely evaporated. And therefore, you see the massive decline in the pound as a result of this, from 170 to 160. So pound now is playing second fiddle in the market, and that's kind of how we stand for the time being. Aussie hanging tough. We don't have we have RBA obviously, and we have retail sales, but again, that's a neutral story here in the Aussie. Aussie just sort of holding out here. Certainly got a little bit of a boost from Aussie yen trades, but generally Aussie is sort of an 87, 89 trade with very little volatility. Ironically enough, a pair that used to be massively volatile. One of the most interesting things that you can note about the commodity dollars is just this incredible compression of volatility, because we really don't have any fresh policy shifts. It's sort of as neutral as can be. We also have Kiwi data. We have Kiwi employment data post RBNZ, which continues to sort of press down on the pair. It still remains a little bit under pressure, and the 77 here is certainly a very vulnerable point. A break of the 77s does open up a fresh move to the downside. The only reason I can see like a very severe break in the COM dollars is if the U.S. data really surprises strongly to the upside, where the market becomes utterly and absolutely convinced 100% that the policy shift is coming, that 25 basis points is going to be done even as early as Q1 of 2015, and then of course radically shifts the carry trade out of the dollar into, out of the Aussie into the dollar on interest rate differential moves, and that's why the COM dollars could really start to move to the downside. So it really have to require strong positive U.S. data for us to break these levels, but nevertheless we're close, and it's well worth watching how this trades out. The other story of the day today was these really disappointing numbers out of Canada. Not really disappointing, but just mildly disappointing, but just very, very negative price action out of dollar CAD. We had lower than expected GDP growth. Clearly, growth in Canada is struggling primarily because the commodity-based economy, and certainly the oil-based economy, is starting to feel the pinch of lower oil prices, especially as we slip below the $80 level, which is a break-even level for a lot of the tar sands that Canada produces. So this pressure on the commodity sector certainly having an impact on Canada as it translates into weaker than expected economic growth. We do have data next week, so of course we'll be watching it. For now, this 1350, very, very key level, and in many ways, it's really going to be, if you have a sort of a double whammy combination of really strong U.S. data, really weak Canadian data, this thing will go. And then we'll be looking to 115 on the dollar CAD, and that could be a very, very interesting trade as we go forward. So there is these very, very seminal resistance levels that could be pushed if we do get a complete, radical change of policy perception next week based upon the economic data that comes out. Other than that, it's really going to be a very, very active week starting from Monday and going all the way to Friday. So expect to have a lot more volatility and hopefully a lot of good trades. Wishing you guys the best of luck and the best of trading. This is Boris Schlossberg, over and out.